In this video, we're going to talk about financial reporting for the insurance industry. And we're going to review the common financial statements that insurance carriers use to report on the performance of their company over a period of time. And one way to think about financial statements is that they're really nothing more than a mirror. They're reflecting what's going on in the operations of the business. And they're giving you a look inside of the company. So the income statement, the balance sheet, the cash flow statement, they're really just different lenses. They're different parts of the story that's being told about the company. Because finance can really be viewed as the common language of business, and it's the language that we use to tell the story of the company. And who are we telling that story to? Well, a lot of stakeholders in a business look at financial statements, and here are just a few. Within a company, owners want to know if they should stick with it or put their money somewhere else. And managers want to know if what they're doing is helping the company make money. Outside the company, suppliers and lenders want to know if they should continue to do business with you. And obviously, customers want to do business with a good, solid company that they can trust to be there for the long haul. So financial reporting is about communication. And our specific objectives in this discussion are to review how an insurance company makes money and how they demonstrate that to the various stakeholders in the business. And we'll talk about the three key financial statements: the income statement, the balance sheet, and the cash flow statement. We'll also talk about the fact that cash is not always the same as profit for a company. And let's start by talking about cash and what it tells you and what it doesn't tell you. Let's say that you have a company, and as you run it over a period of time, some cash flows in and some cash flows out of the company. You issued stock, you sold some product, you borrowed from a bank, and some cash came in from those activities. And let's say in the same period, you paid commissions, you bought a new computer system, let's say you did some marketing, and cash went out based on those activities. Such, if you net it all out, your cash inflow and outflow in the period totaled a negative $53,253. And that sounds bad, right? Because it's negative. Or is it bad? It kind of depends. What if you had started with $10 million in cash and it went down $53,000? Then that doesn't sound so bad, does it? But what if you started with $60,000 in cash? That would be a different story. And what about the assets that you own or the money that you owe? But just by looking at cash flows, important though cash flow is, it wouldn't have told you about those things. So to understand the details, we also need to look at the balance sheet. And what about profit? Are all these cash flows impacting profit? We need more information. We need the income statement. Interest is an expense that impacts profit, but dividends are not an expense, even though they're an outgoing cash flow. So to really understand the story being told about the company, we need more than just cash flows. There are three main financial statements at companies. The income statement compares revenue and expenses over a defined period of time. The balance sheet shows what the company has in assets at a point in time and who owns the assets, that is, the liabilities and the equity in the company. And the cash flow statement gives you detail about the cash inflows and outflows for the company, also over a period of time. And the cash flow statement is not actually even a separate financial statement. It's just a little more detail. It's the worksheet they had to do to come up with the cash line item on the balance sheet.